Well, hello and welcome to this InvestSMART seminar that we're giving on regarding particularly to our high growth and core growth portfolios. I've spoken about this many times before. I love how they work. I love how globalization fits into that. So that's all part of what I do, what I think about. So what I want to really talk about today and why I see the core growth and the high growth portfolio as really interesting at what's happened, particularly in the last period, is around time. And time is something that I want to talk about quite a lot in this presentation, about why time is so important to your thinking as well as what's going on here and now. I'm going to run through several things with the first part of the presentation around what's really catching my attention in markets right now and sort of things for you to be aware of and looking at going forward, and then really talk to you about how the portfolios are set up and what we at InvestSMART are now really excited about, which is also our capped fee structure. So let's sort of quickly just go through the disclaimer stuff that we normally have to go through and have a look at that. So as always, please just have a very good walkthrough of the disclaimer on screen. Everything in this video and in this presentation is general in nature. So just remember that. None of it should be taken as any form of personal advice. InvestSMART does not know your personal scenario. Therefore, we shouldn't be taking this as anything else other than basically what it is, which is basically opinion and points of view. So very quickly, you can see sort of outlining what we're going to do. And the first part of the presentation, as I said, we sort of take you through where we are right now and how that looks and what's happened. Particularly, I know a lot of you are probably thinking about what's happened over the last couple of weeks, couple of months, how that fits into things and what that goes through. Then, as I said, really moving on to risk return and how I look at risk return and how the portfolios that we construct here are set up around that idea. Because the thing from my point of view that sort of gets missed in all of that is time, and I'll explain why in a minute. So let's have a look at growth and income, having a look at sort of how we here in Australia particularly look at markets, how we look at the ASX, how we look at investing in equities, etc., and all that kind of background. As I'm sure you're well aware, we don't just offer the PMA accounts, we also offer actively managed accounts. Nathan Bell did a presentation last week. By all means, I recommend you go and have a listen to it. He's got a very unique and beautiful view about what he does, and I love how he goes about it. And what I do is a little bit different. I'm not here to pick stocks for you. I'm not here to sort of point out this fundamental difference, although I've done that in the past. What I want to sort of do is talk to you about how do you just get exposure? How do you get exposure that works? How do you smooth out volatility? How do you actually make sure that the portfolio that you go into actually meets your needs? All of that needs to be part of your thinking as well. And that's what I now do and how I look at sort of moving my period forward. So let's sort of start with sort of just some history. Let's have a look at where we sit, what we are, and sort of where the ASX sits. So this chart on screen, I love this chart. It really gives you a chance to have a real good look at a few things. So if you have a look, the yellow line is very interesting. So this is the chart of major, basically, indices across the globe over the past 7 years. Now, the reason I've taken 7 years, the time frame for the high growth portfolio is 7 years or more. So I want you to keep that in mind, that the time here is absolutely key. And you can see that if you got back into the market, basically end of 2011, so November 2011, to where we are now, you can see very clearly, even with the current pullback that's going on in the NASDAQ, it's up over 200%. And that's just on capital returns. That's not total returns. You can also see in there, particularly have a look at the salmon and also the dark blue line. That's the S&P and the Dow, and you can see very clearly how well they've moved out of there and continue to be such a strong return over the last 7 years. Interesting one for me is the DAX. The DAX is a beautiful indication of perfect market diversification. If you ever want to look at the 30 best stocks in Germany, the DAX is it. It's basically between 7 and 14% per sector. So that's like automakers, biomedical, financial, insurance, staples, discretionary. You take your pick. Those 30 stocks, no more than 14% per sector. And it is a perfect indication of what a diversified market is. But you can see very clearly it's the only real European market that really stands out. You've then got the MSCI World Index, so that's the 23 global indices put together in one index, and you can see it's sort of sitting there in the middle of it, and then you can sort of see the rest. Unfortunately, for the ASX 200, you can see we are basically neck and neck with the FTSE, and the FTSE has obviously had some interesting scenarios since 2016 with Brexit. You've also had some other things that have rolled into it, and unfortunately, we here in Australia just haven't really moved the way you'd want it to be moving. And that, therefore, is why I want to start with that point. The reason I show you this start here is that when you look at diversification, it's not just diversifying inside a market. So it's not just looking for what's my healthcare sector exposure, what's my materials exposure, my banks, have I got a little bit of income, maybe around sort of capital goods, blah, blah, blah. Diversification is global. It's looking internationally, it's looking domestically, and it's looking across assets. So this is the first part of that, to show you that domestically we are a good market. There's no doubt about that. But on a capital basis, we underperform and have underperformed basically since the GFC. Not only that, we always talk to you about total returns, and total returns are key to everything that we do. And that's where the ASX actually does close the gap a bit. And you can see this chart. This is the total return chart, so the relative index that we've got of the main ones I really want to show you, being things like the US, the NASDAQ, FTSE, again, the Dow Jones average, and us here. You can see that once you add that in, the returns are much, much better. Now, you can see over the last 7 years, the ASX has, on a total return basis, it's just on 80%. In fact, it's just a little bit over. But again, you can see very clearly that the US is well and truly ahead. The interesting thing about the US, and I will go a little bit fundamental here, is that the return on equity, the earnings per share returns that they have in the States is almost 2 times better than everywhere else on the planet. So for every dollar that we make, they do it about 2 times better. So they're making about $2 or even more in some perspectives. That's why the NASDAQ is so incredibly strong. But again, you can see very clearly that the international exposure overseas has done very, very well. You can see here the Hang Seng is the next one to look at. The Hang Seng actually is probably the next best yielding market on the planet behind the ASX. The ASX is actually the best in the developed world. It averages around about 4.4 to about 4.6 over the last 7 years. The Hang Seng itself is around about 4 to 4.2. So they give you quite reasonable returns, considering that the Hang Seng is almost an emerging market. It's very much an emerging market exposure. So you are getting a little bit of risk return, considering the risk that you get exposure to the Hang Seng, because it can move quite dramatically. So let's sort of have a look at what sort of happened, particularly over the last sort of couple of months. Realistically, it's not even that. It's actually around 50 days since the volatility that's sort of flipped into markets. It's been there. We get questions all the time around this. And the reason I want to show you this is that this shows, again, why time is key, because there is a bit of fear out of there. The performance over the last 50 days, as you can see on this is again back to capital returns rather than total returns, is unfortunate. But again, it shows that if you are only looking intraday, intra-week, intra-month, you are going to experience this. You are going to experience downside. It's going to make you nervous. It's going to make you question what you're doing. It is going to probably cause you to probably make a mistake. And that is the interesting thing about all of this, and the interesting thing around what those charts before showed you with total returns, even on capital returns, is that the longer you're in the market, the more time you give yourself to smooth out volatility, the better return you're going to get. It is actually proven that if you're out of the market completely rather than being in the market during volatile periods, you'll still actually underperform. So what I mean by that, let's just concentrate on our market. Let's just look at the ASX. If you look at the ASX over the last 20 years, we experience a correction, so that's 10% or more, not 20% or more, but 10% or more over the last 20 years, about once every 4 years. So it is a fairly natural part of pullback and a correction at that. If you have a look at the returns that were given over that period of time and the amount of bull markets we've had one every 4 years as well, and they normally precede a correction. The other thing about that, a bull market is 20% upside or more. And the only time we haven't really seen a really strong bull market was during 2012 to 2016, where we did have things possibly like the China hard landing issue. We had the Eurozone crisis issue. There was a few other bits and pieces that just made things a bit volatile post the GFC. But if you look at 2009, most markets on a total return basis were up 55%. If you look at it on just capital, it was about 30%. So again, looking through what's on screen here, so this is the last 50 days, you can see that, yes, there has been some volatility, there has been some pullback. Again, the NASDAQ is the one to sort of highlight there. You can't have the kind of upside returns that they've given you over the last couple of years and not have the same sort of volatility to the downside. So they're the ones that are underperforming quite dramatically over the last 50 days. I'm sure you're all aware of what's going on inside FANG stocks. You would have heard about what's going on with Facebook and some issues facing them. Netflix continues to need to make sure that it's got monthly average users. And then there was talk around the fact that Apple is seeing a slowdown in demand for iPhones, and suppliers to Apple have actually had to change their outlook, and that has certainly put a major pullback on Apple as well. Interesting thing again is I would probably highlight the US markets as a whole. So again, look at the salmon line, look at the navy blue line, the NASDAQ, and also, the Dow and the S&P. And you can see that, yes, they're underperforming, and yes, somewhere like the Hang Seng has actually done better over the last period, but they're still in the top 3 and the top 4. So even with these higher volatile periods, the US does tend to have a correction on average about once a year. So that is something to be aware of when you do go into a higher growth, slightly higher risky market. You are likely to see, downside on a more regular basis. But in saying that, they tend to bounce back quicker. And you can see that those lines move faster, move harder than if you look at our line, the sort of that teal line that's in there. We're unfortunately in the middle of the pack. We're underperforming. We're down around about 6.5%, 7% in the last 50 days. It's not as bad, obviously, as the world index. It's not as bad as probably what's going on in the NASDAQ, as you said, but we're not near to the top. We're certainly not doing that well. And again, we are exposed to emerging markets, etc. And again, it just gets back to my point around why the high growth and core growth portfolios are trying to diversify you across the globe. It's trying to diversify you across markets to smooth out the volatility that this shows you, and moving from there. But again, let's put a bit more of that into perspective and have a look at it. Because the other thing about it is that although that last 50 days has been volatile, although the last 50 days sort of move around, this chart here actually shows you the volatility indexes in the US and also here in Australia. So the Australian Volatility Index is the green one. The VIX, as it's called over in the States, is the salmon line. And then what I've also deliberately put in there is the 10-year moving average of the ASX VIX and also the 10-year moving average of the VIX over in the States. And you can see, although the last the last 50 days has been quite a movement, and I'm sure it's been all over your screens, all over what you've read in the news, it's actually about normal in terms of what you can see on a longer term trend. You can see that volatility where it currently sits, so the ASX is actually below its longer run trend average. The US is now probably sitting at trend. Is that what we've probably got used to is that over the last year particularly, the very low volatility is actually abnormal. It's not the normal. And that's, again, what I'm trying to get to here is you want to look through the volatility. You want to look through the monthly movements, the monthly gyrations, and the monthly talk, particularly the daily talk, and look at it from a longer term perspective. Because you can see here that markets do move. They are volatile, particularly equities. And if you look at volatility sort of averaging around about, as you can see on that 10-year moving average, between 16 for the probably more likely 17.5%, and around 18 for the US. If you expect that volatility sits at that kind of level, then you can actually be comfortable and understand that if I've got a time frame of 7+ years, a short-term volatile spike like we're currently seeing, which isn't even as near as strong as what it was in February this year, that I can handle that. I can understand that although I might be down right now, going longer term, I can see this smoothing out. I can see volatility falling away, and I know that my positioning in my portfolio actually can see through this and help in that way. And that's sort of the best way to look at this and sort of understand it from that point of view. The other part of the perspective is that if you look at this again and put volatility into that over the last 7 years, the ASX return is fantastic. And it gets back to that chart I showed you on the second one. You can see that on a total return basis from 2011, so late 2011 to now, we're up 41.64%, and that's just on capital. But reinvested total return sees you up 93.34%. And that's just the ASX. And that is why, again, being in the market, even during volatile periods right now, over the longer term, will smooth out and actually see you through. It will actually grow your wealth in a way that you just can't get through cash or being completely out of any market and putting it under your mattress. It just, again, it's around that idea that you do want to be and understand that, yes, I am in a risk asset, but time and time again, over the longer term, the return that comes back to me is what and why I'm in this kind of space. The other thing that's interesting, and just another bit further on the perspective, getting back to the ASX, is that we have actually changed as investors, and that's the other thing that can sometimes make investing a little bit tricky. If you had talked about the ASX even as little as 3 years ago, they called it a barbell. You'd basically look at it the point of view that you would buy into, the banks, probably having 2, maybe 3 of the banks on one side of your barbell. You then on the other side have your resources, most likely BHP and Rio, and then skinnily through the bar, you'd have exposure to other sectors. What this chart is showing you is that basically since 2014, we as investors have been changing, and the returns outside of that barbell structure has been better. And that means, you can very much pinpoint that down. Healthcare has been an absolute core pillar in that change. You've then got high growth products. You look at things like A2 milk. You look at sort of products that things like Afterpay. You look at high quality companies that have actually changed that barbell structure. The Banking Royal Commission, clearly, the China story and the slowdown through 2015-16 caused resources to go backwards. And so that structure is no longer there. And that also means that there is a little bit more risk in looking at the ASX and doing it that way. So the reason we offer the products that we offer, the reason that we offer and why I manage the PMA accounts and they are passive is because I want to remove that sort of having to do that in-depth work. I want to remove that from you. I want to look at it from the point of view that I want to help you get diversification. I want to help you get a spread across global markets, a spread across assets, fixed income, property, cash, international equities, domestic equities, that can take away the changes that happen internally and actually just go, right, I actually am very happy with the market returns. I'm very happy with what that means, including on a total return basis. I now need to look at it from an overall divestment and investment perspective. And that's why I want to go to this part and come to the next part of the whole idea is that diversification, as I said, it's not just domestic, it's global. Because the other way to look at it is that most people, when you talk around risk return and you talk around diversification, blah, 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 most people, when you actually, and particularly when you're at university, I think this chart's really interesting from the point of view that I hate it. This is how you taught risk return. So you can see bottom corner, if you go into cash, it's low risk, but low return. Fixed income, it's a little bit more risk, but a little bit better return. Property, same again, and then equities at the top. Sometimes you actually see that top square being sort of moved out to have domestic equities and then above that international equities. That's fine, but this isn't actually how it looks. It's not linear. It's not that sort of clear that you go, right, cash is going to give me X amount of return for the risk that I put in. It just doesn't work like that. It works like this. This is a better way to look at it. And this also shows you why you don't put all of your eggs in one basket. We here at InvestSMART are very strong on that. We say this very clearly, that an equity market, the ASX, is one part or one egg or one basket in some respects, because basically you're exposed just to the Australian economy. You're exposed to basically 14 stocks if you really look at how the ASX works, and that doesn't necessarily work for your overall returns. It also shows you how time works over that same period. You can see very clearly that once you add time, that chart here just doesn't come out the same way. You can see very clearly that equities, domestically and internationally, well and truly monster what goes on in fixed interest and also what goes on in cash. Now, I've defined fixed interest here as this is a basket of the Australian corporate fixed interest market. And I then defined cash here as basically the Aussie 10-year bond. So if you were just basically to go and buy the government sovereign 10-year bond and had held it for the last 7 years, this is what you would have seen in terms of capital return. It doesn't move. Total return, it would have seen you around about 10% over this period. But what it shows you is that real risk returns have time involved, and time is core to your thinking. It's why I've been saying it pretty much all the way through the presentation. It just acts as a tool. It gives you that ability to actually think about things and smooth things out. Because what you can also see on that chart, have a look at what goes on in the MSCI World Index in midway or end of 2014. You can see quite a blip there. Then the start of 2015, end of 2015, start of 2016, you can see quite a blip there as well, where you're actually down. And I'm sure if you started investing there, you'd actually probably see yourself originally, international equities were down. Longer term, the smooth out, the upward trajectory has been maintained through that. And that's why coming to this, time is key to everything. So what I want to show you with that is that, again, looking at the last 50 days, it makes no sense to be looking at it on a short-term basis, because you can see that you'd be down on your risk assets, and that's exactly what you'd expect considering the volatility over the last period. But you've got a buffer. You've got the buffer in the fact that if you're diversified with some small exposure to fixed income and some to cash, it does add a buffer. It just adds that backstop to smoothing out the volatility that can come in equities and smoothing out the risk that you're exposed to. So diversification isn't meaning that you basically go, right, I'm going to just get international equities and Australian equities and just go for hilt. Even our high growth portfolio is not exposed in that way. That's not the way you look at diversification. Fixed income and cash are still very important. The constant income, the capital protection that they provide is still core to how you should think. Because again, in 7 years' time, you could be actually going through a volatile period, and at least then you've got some form of capital protection. And you should be monitoring this on a regular basis, because the closer you get towards your time frame, you should be actually changing your overall setup. That's probably something to talk about for another day. But in saying that, you can see very clearly, if you were to look at what happened in the last 50 days, this chart looks much different to what this chart does. And that's why you need to probably be thinking time is key to everything, and time smooths out volatility. So if we come to that, now bear with me on this table. This table is another way to look at that over a longer period of time. What I did here is I actually put together, EM stands for emerging markets. You can see fixed income for Australia. You've got DM, which stands for developed market equities, global fixed income. REITs is global, it's not just Australia. What I've done there is I've actually broken down pretty much across the asset classes. And that theory port, that's a theoretical portfolio. If you were exposed to these on a fairly growth-orientated basis, and how it would actually look to you. So it's basically roughly about 25% exposure to Australian equities, around about 25% to Australian fixed income, and then 10% across the rest of the asset classes. And if you have a look, although at the start, so 2007, 8, and 9, the portfolio moves around a bit, as you go through that, it smooths itself out quite dramatically. And then if you have a look at the back end of it, if you look at the annual return, this is over the last basically 10 years and all the way year to date 2018, you've been returning on that portfolio setup roughly around about 7.1% per annum. And that's on a total return basis. And that, we believe, on what this would actually probably be more considered a core growth to maybe even slightly more balanced setup, is absolutely core to this. It smooths out the volatility, because if you actually then fixate yourself on one of those assets alone, so let's, for instance, fixate on the Australian equities, 2017 was pretty good, 2018 was interesting, and then we had a massive collapse in 2008 and 9. If you then go through to what happened and look at what goes on in 2011, you can see, again, movements in 2014, etc. It's all over the shop. And that in itself, I think, is why this chart, this table shows you very clearly that things move around, and move around quite strongly, even in fixed income, even in cash. And if you can smooth that out, it's going to add to your overall returns on the longer term. So let's talk about that. How do we position for risk, return, and time? And that's where our portfolios come into it. That's where we think the core growth and high growth portfolios really work to your advantage. So this here is how we've set out the core growth portfolio. This is exactly how it is. We use ETFs. We believe that they are a very good product for setting you up to give you that sort of diversification very clearly. They are very, very cheap in terms of how they run, and that is core to what we think. They can give you exposure, basically, again, perfectly set up to the indices that we want to be set up to, and give you that chance to really look at it. And you can see here, if you look at the pie chart on the right-hand side, you can see that there's a reasonable amount of international equities, and that includes obviously the international property that's inside there as well. You've got the Australian percentage set up as well. Then you've got a decent amount of exposure to cash, but also some reasonable amount of exposure to fixed income. And you can see that at the bottom. The time frame we believe for this portfolio is 5+ years. So it does mean that you need to be thinking, okay, if I go into this, I'm not realistically going to need it until at least 2023, and realistically, I'd probably even say more likely 2024, 25 is where I'm looking to get this money back. So 5 to 7 years from now, it gives you good growth with a buffer because you've got that fixed income behind you. So to actually show you the performance, I actually think this is a really better way of doing it. That portfolio we've been running now for pretty much, it's just a little bit over 4 years. We had our 4th year birthday on it last month. And you can see very clearly, if you put 10 grand into that portfolio over those 4 years, compared to our peers, you can see where we're at. Now, you can see very clearly that we have had a volatile period basically since September. And we know that, and that's what we've just been going through. But even with that volatile period, even with that change, you can see that because the portfolio is diversified, because we do have that buffer with fixed income, we've actually managed to smooth out the volatility seen in international markets and domestically. So the portfolio here has only declined around about 3.5% over that period, whereas international markets, as we showed with something like the NASDAQ, is down over 10.5%, the ASX is down 5.5% to 6%. This is why it smooths it out. And we continue to therefore make sure that we outperform our peers. The core growth, the amount of peers that we have is over 1,000. It's about 1,085. And we're very proud that we show very clearly that we are performing very, very well over the 4 years that we've had since inception. And another way to look at it, we also believe because we know that we have a small charge when we do what we do, we are not likely to outperform the benchmark because basically we have passive investments that follow the market perfectly. And a benchmark is obviously the market without those fees included. So we can actually show that even over the last couple of months, we've actually outperformed the benchmark, well and truly outperforming our peers. And that shows you that, again, we are doing the correct thing. We're following that our diversification is correct and that we're making sure that our core growth is exposed to that idea over the longer term. We don't expect to outperform the benchmark because in the end, as we said, we're passive. But what we should be doing is we should be as close to benchmark as possible. And realistically, we should be only underperforming the benchmark by the fee that we charge. And I'll come to that at the end. Just very quickly and finally, part of the core growth portfolio setup, you can see here that this is the diversification of the core growth to peers. And we're pretty close in terms of how we look at our asset allocation. So we're a little bit under domestically, we're a little bit over internationally. Just a bit of a caveat, the one at the end there where you can see property, we're quite high to our peers, but we don't have other. The reason for that, peers tend to actually diversify out international property and their domestic property. If you put them together, because the other is international property, if you put them together, we're pretty much bang in line. So you can see that we are actually following pretty closely to how we should be in terms of making sure that we are close to our peers in terms of their setup, but making sure that we offer you the best and closest possibility to benchmark to give you the best return over the longer term. Moving on, and those of you that now want to look at a little bit more of an international flavour, those of you that are expecting and want a bit more high growth, that's what we certainly believe has happened over the last couple of weeks, the last couple of months. The thing about what's happened, the pullback, it actually gives you the opportunity to reassess. It gives you a chance to go, okay, I've got a cheaper price. I'm not actually going into markets that, probably some people would argue at top. I've had a decent pullback. Markets are cheaper. That gives you that chance to sort of go, okay, I've got a cheaper price. I've got a 7-year investment time frame. I can look at the international exposure and look at it from the point of view that things do look like they're going to continue to grow. And that's why the high growth portfolio is really, really exciting. You can see very clearly here that the international exposure really moves up quite strongly. The international exposure we have there is actually through the Vanguard International ETF. That's excluding Australia. So it's the 22 of the 23 MSCI World Index, obviously not including Australia. And the major exposure, about 62%, is to the US. And as we showed you at the start of the presentation, the US has and is likely to continue to monster the rest of the world. From there, you get exposure all across Asia, into Europe, and to most of those emerging markets that are seen by the MSCI as core, they're all in there. So you've got that ability to make sure that you're exposed correctly. You get the emerging market exposure that can give you some really strong upside, but also buffers you from the downside because the exposure isn't as high as to a market like the US or to Japan, to the DAX and most of the European markets. But it gives you a perfect diversification internationally, but gives you that core risk that you want, which is that international equities over the longer term tend to outperform domestically. And that's why the high growth is positioned the way it is. Again, we haven't completely cut out cash and fixed income. We still want you to have the diversification. We still need you to have and want you to have a buffer that if we do go through a volatile period, that there is some capital behind you that's unlikely to move in the same sort of level of movement to the downside as what it can to the upside as well. Again, your time frame here, have a look very clearly. It's 7 years or more. So we are now talking sort of 2025, more likely 26, 27 in terms of what you're thinking. And that should be how you look at this, is that I'm looking at this to have a good long-term high growth return, total return idea where I will actually see over the longer term a much greater sort of movement to me. And you can see that again in our performance. Again, the high performance growth portfolio has also just celebrated its 4-year period. You can see that if you compare the core growth, the performance is better. So we actually have made more money, but at the same time, you can see the last sort of period has seen a stronger downside. So we have been, because we are more exposed internationally, because we're more exposed to equities, which do have a high level of risk, that we've actually therefore seen a little bit more downside. But again, because we've got a longer term time frame, because we are looking at what we expect to be looking into 2025, 26, 27, this small blip really doesn't affect us. And you can see it's had several of those over the last 4 years itself. But at the same time, we're not too concerned about that. And again, what we're really proud of is that we're still outperforming peers. The high growth portfolio has around about 850 peers against it. And the fact that we're outperforming them quite neatly is again, something we're very, very proud of. Finally, again, coming back to the performance to peers to benchmark, you can see that we're here in the teal, benchmark is in the salmon, and then you've got the navy blue for peers, that we are doing very, very well across that period. And we think that that's how it should be. Again, the same setup. We expect and we understand that we're likely to underperform the benchmark basically by the fees that we charge. And the changes to our fees certainly will make it even more impressive because we think we'll get closer to the benchmark. But in saying that, we are very, very close, and we're very proud of that we are as close as we can get to benchmark with a passive fund, and that we continue to outperform our peers. Again, the last part of this obviously is asset allocation, and we can show you very clearly that we're quite close. It's the same setup as before. You can see that the other needs to be just put with property. We're a little bit under on both, but that's fine. We actually think at the moment that we're closer to benchmark rather than peers, and that's probably the right thing. The benchmark has got a little bit less exposure to Europe, whereas our peers have got a little bit overexposure, and that's actually come in our favour. We know Europe's had a bit of a terrible year, so with that in mind, we think this is close enough to basically exact. But at the same time, that slight underexposure to Europe has actually been to our benefit, which we again quite like. What I now want to come to is actually what's happened at InvestSMART in the last month, something that we're very, very proud of. We've actually become the first provider of these products out there to cap our fees. We think this is the correct thing. We understand with what has gone on that this is the correct way to operate. We think and we know that if you want to make a difference to your total return at the end of the time, the lower your fees can be, the better it is. So therefore, the maximum you're going to pay now going forward on an administration cost is $451 per annum once you get to or above $82,000. So what this sort of slide shows you very clearly is that if you were to invest $1 million, which is what the big one shows you, that you're only going to be paying $37.58 per month going forward. So that's 0.05 per annum, which means, again, you're capped at $451. Even if you've got as little as $10,000, which you therefore, the maximum you're going to pay per year is $99. So it's $8.25. Once you get to $18,000, it gets to about 0.55 of 1%. You still sit at that 8.25%. So $8.25 a month. It will scale up ever so slightly, but once you get to that 82,000, you are capped out. And that we think is the correct way. We think that is the best way to manage your funds because, again, we are looking to give you and protect your wealth as best as we can without impacting your cost and your overall returns longer term. Because we know longer term, as we've shown you, that those peers that actively manage tend to outperform the benchmark. And the closer we can get to the benchmark, the longer and faster we're going to get you towards your actual return that you want to be. There is, as you can see, there are a couple of little brokerage fees. We don't turn the portfolios over very rapidly at all. In fact, for instance, the high growth and also the core growth haven't seen a change for several months. We don't expect to see it changing anytime soon. But with that in mind, there is a small brokerage fee, but it's very, very small. As you can see, brokerage starts at $5.50 per trade or 0.11 of 1% of the total trade done. Again, it's very, very small, and we will forewarn you if we think there is any changes. So that is how we look at the overall portfolios. That's how we look at the overall market, and what at the moment I'm quite excited about. I do see growth in 2019-20. I do see the overall longer-term trend still maintaining. There will be blips. We're fully aware of that, and that is certainly something that we understand. But what we now believe and what we are looking for going forward is to make sure that we can offer you the best return as close to market as possible with the best diversification that we can. So with that, I'm going to leave it there. If there are any questions, please, by all means, just log in now and actually write through. So if you are still on the line, if you just click onto your GoToWebinar panel, there's a questionnaire panel there. If you just sort of click onto it and write in your answer and click enter, I'll be able to answer any questions that you've got. And it doesn't have to be about the portfolios. It can be about markets, about where you think, what my opinion about where markets could be going, what 2019-20 looks like, setups, etc. Any question you can think of. The first question that's come in is actually around what might happen in the US in 2019. It's a very broad question, but a good one at that. There is still very decent signs that the US is going to grow at a pretty reasonable rate. So it's likely to slow. I mean, it's growing at the moment at around about 2.6, 2.7% per annum. We know that President Trump has been quite stimulating with his programs over the last 2 and a bit years that he's been in the White House. We've also got a Federal Reserve, so their RBA over there, that has been raising rates just to slow things down a little bit because they have unbelievable employment and basically employment that we here in Australia would kill for. The unemployment rate's about 3.8%. They've got wage growth at 2.7%, excluding bonuses. They've got an underutilization, which is those that are either basically part-time employed or unemployed at a lowest level it's been in 7 years. All that's moving in a direction that shows that there is still a very strong economy behind it. If you look at earnings per share growth in the States, it's still at around 20% at the last numbers that we saw in Q3. So the US is still doing very well economically and then also on a company basis very strongly. It is expensive. If you look at the S&P and the Dow, that can't be excused, but the pullback has certainly moderated that. It's most likely that next year we'll see US markets having what we call a fat skinny. So they'll probably have a fairly flat year. The expectation from most participants is that it'll grow at about high single digit, low double digit returns next year. It will have a couple of volatile periods, but in the main, it probably won't be a 2017 definitely, which was a very strong year. It'll be more like what we've seen in the sort of midway through 2018 and flat growth across it. I'm still quite positive on it. I still think the US economy is incredibly strong. I still think what they're doing over there is likely to mean that it'll outperform it. And that's why at the moment you can see the portfolios are still weighted towards the US. And that certainly is what we've been seeing going forward. Second question is Europe. Do you see the likes of Brexit the European Union issues playing out in 2019? Certainly do. Brexit is an unknown quantity, and although I've just spent the last sort of 35 minutes saying don't look at the short term, I'm going to have to say that for the moment. For if you are looking at the UK, the next 2 to 3 weeks over in the UK is going to be an amazing period. Just looking from the outside in, Theresa May to get her fire withdrawal agreement that's been signed off by Brussels through the Commons is going to be very, very interesting. Numbers would suggest that she doesn't have the ability to go through it, and the volatility that could become on the FTSE off the back of that would be huge. So Brexit's a hard one. It's certainly one we don't watch. We don't have direct exposure to the FTSE. We don't have a setup where the FTSE is the only thing we have. When we go in and talk about Europe, the UK is included in our European exposure, basically through our, again, as we showed, that world MSCI. So it just depends on how much the FTSE is exposed to it. And it's only around about 4.5%. So it's not a huge amount of exposure, which is good because clearly there's going to be a volatile event. The vote is due between the 10th and the 18th of December. So that's one part of it. Europe's a different one. Europe's quite interesting. As I showed you at the start, the DAX has been a massive outperformer, but the rest of Europe's been a real drag. Unfortunately, the renaissance that was supposed to be the European year this year just hasn't materialized. Clearly, the threats from the president and the fact that he's threatening to hit one of the biggest exports out of Europe, being the automakers, with a tax, has not helped. European banks this year have had a shocking year as we've had issues around possible, again, defaults in some of the periphery smaller countries. Next year also has got the problem around, we've got the European parliamentary elections. So that's actually those that sit in Brussels. There is rising concern that the populist parties over in Europe could actually feed through. How that looks will be interesting. There will be volatility off the back of it. Next year, at the end of next year, it's likely we're going to have a German election, and we already know that Angela Merkel is not going to be the Chancellor of Germany. What does Germany look like post that is an interesting question. And the final part of that whole conundrum is Italy. Rome at the moment is quite a thorn in the side. The fact that they can't get their finances in order, they've got a populist government that wants to do certain things that's certainly against what Brussels wants, makes Europe quite interesting. So all of that, my view is that that Europe will underperform. It's likely that Europe will see short-term issues. Again, don't look at that. Look at the longer term and look at what we're smoothing out. The exposure to Europe is only around about 14.5%, 15%. It's more around the US. It's more around us here in Australia. What emerging markets will do next year, I think that's more the interesting question. Are there any more questions out there? If you do, please, by all means, just type in, as I said. So that doesn't look to be. So with that, I'm just going to leave it there. Thank you so much for listening in. Thank you so much for joining the webinar. If you do have any questions or any sort of other sort of periods that you want to ask about, please don't hesitate to write into us here at InvestSMART. It is just clicking on the little sort of text box in the bottom right-hand corner when you go onto the website. The team here will always be happy to talk to you. If you do want to speak to me directly, please just contact them and they'll put them through to me. Always happy to talk about the portfolio and always happy to talk about markets. Have a great afternoon.